Good morning and welcome to this week's What's Affecting Oil Prices. I'm Jeff Quigley, Head of Energy Markets here at Stratas Advisors. In the week since our last edition, Brent crude rose to $54.87, another healthy gain from last week. Brent will average $55 this week as geopolitical tensions offset some potentially bearish data releases. In terms of inventories, we expect U.S. crude stocks to build by 2.6 million barrels, while the WTI Brent differential remains wide at $5.50 for the week. Iraq is the key area to watch this week as the Kurdish region of that country has scheduled an independence referendum for this Friday. Baghdad opposes the vote, and any attempts to keep the country unified could presage violence in the region, which is home to roughly 500,000 barrels per day of oil production. This is happening in parallel with continued tensions on the Korean peninsula. The dollar's relationship with crude diverged slightly last week, but remains reasonably strong. The dollar saw some temporary support from Hurricane Irma, but was again pushed down by weak retail sales data. Strong support for bullish sentiment came last week when the IEA and OPEC both released bullish monthly oil market reports. Steady supply forecasts and an OPEC deal that is being deemed as effective has put the emphasis more directly on demand expectations, which continue to improve. Last week, the number of operating oil rigs in the U.S. fell by 7 according to the weekly report from Baker Hughes. U.S. oil rigs now stand at 749 compared to 416 at the same time last year. Globally, fears around oversupply are easing as OPEC's production agreement continues to work. OPEC's latest monthly report indicated that August production fell, the first drop since March. U.S. gasoline rebounded sharply in the week ending September 8th after being depressed by Hurricane Harvey. While Stratas Advisors expect strong demand growth in this year and next, we caution that ever-increasing global demand growth estimates could lead to unjust disappointment at the end of the year. The return of a significant portion of Gulf Coast refining capacity cut margins around the globe. However, runs remain healthy and margins are generally still elevated, supporting Brent. Margins will likely stabilize in the week ahead, just in time for fall maintenance season. This analysis is part of our short-term outlook. Please contact us for more information.
For more videos like this, go to our YouTube page at youtube.com/heartenergy.